Okay, let's get started. I'm Carl Turner. Welcome to Expat Tax webinar on for tax planning on crypto tax rules. I'm the co-founder of Expat Tax Thailand, and the purpose of this webinar is really to provide you with the up-to-date information on how cryptocurrency is taxed in Thailand. We're here to help, and we help individuals with the tax filing obligations, understanding the rules so they can make better informed decisions. Feel free to put the questions in the Q&A box and we'll get through to them at the end. So who's this webinar for? Well, it's for anyone that holds cryptocurrency, for Thai tax residents, or for people that are a non-resident that are looking to relocate to Thailand. So let's start with some of the common misconceptions and misunderstandings about cryptocurrency. And hopefully this webinar will explain the rules and give you some practical tips on how taxation actually works on crypto. So here are some of the common misconceptions. So what we hear quite often. So one of the common misconceptions is crypto's tax-free if you sell overseas and bring in cash or OTC, which is not true. For domestic exchanges, the tax is a flat 15%. It's not taxed currently at the moment in Thailand at any rate. That's changed. Thai Revenue aren't interested in digital currency. We'll go through that in a bit. They've actually put a lot of time and effort into writing the tax law for cryptocurrency. One of the other misconceptions is Thailand can't trace or track assets with common reporting standards. Now that's not true either. And people can just remit capital and not report the gains. That's one of the common questions that we get. So that's one of the common misconceptions. So hopefully after this webinar, it will answer a lot of these questions and misconceptions and clear up a lot of this. So let's get on to the areas that we'll go through. So I'll go through 4 case studies for crypto taxation. And I'll also talk a lot about the tax rules in Thailand, explain what assessable income actually is, what it isn't, and we'll go through the requirements, who needs to file, how do you file, and explain things like common reporting standards, and then we'll get into the Q&A session. So if you've got any questions and you're watching this on the recording, you can go onto our frequently asked questions page. We've got a lot of questions answered. We've got hundreds of questions where we've given answers on our website. And if you're watching live on the webinar, just put your questions in the Q&A box and we'll get through to that at the end. So just a quick disclaimer, the content here is for information purposes only. It doesn't constitute professional advice. It shouldn't be acted upon just from watching the video. This has been recorded. We'll make sure we send this out to everyone who has joined the webinar. So what's actually been announced with the new tax rules? Let's talk about the new tax rules first. So they came into force the 1st of January 24, and it's got a big impact on the Thai tax residents who remit overseas income into Thailand, like cryptocurrency capital gains. So the tax changes that were announced, let's just quickly recap. 15th of September last year, there was a departmental order that was issued, which overruled previous rulings. It was published in the Royal Gazette on the 16th of October. And then there was another announcement on the 20th of November explaining about cash in the bank from previous tax years. So what this focused in on is remitting foreign source income. So if you live in Thailand 180 days or more, and you remit, transfer in foreign sourced income, then it is potentially a taxable source in that tax year. So the key dates for everyone to focus on is the tax year started on the 1st of January, and the end of the year for Thai tax year is the 31st of December. And the last date to file a tax return is actually the first week in April. If you file the paper-based, then it's the 31st of March, 2025. It's a remittance tax basis Thailand, so it's only for assets that are transferred or spent in Thailand for foreign assets. Thailand actually announced, the Revenue Department put out a document in July. They actually published an official document to explain how foreigners living in Thailand pay tax on their overseas assets that are remitted to Thailand. So there's no hidden surprise in the document. It's pretty clear, and all the information is consistent with what we've been advising clients, and also what the revenue's been publishing for quite a while on crypto anyway. The main difference in these rule changes was just if foreign sourced income is remitted to Thailand anytime in the future as a Thai tax resident, it is assessable income. So who will these rule changes affect? So anyone who's in Thailand 180 days or more. So visas, it doesn't really make much of a difference. Elite visa, privileged visa, PR, retirement, business, smart, tourist, marriage. It doesn't matter. All of these follow the same rules. The only exclusion is the LTR visa, which might be suitable for certain people. There's an exclusion on there from foreign sourced income if the income's remitted in the following tax year. This may be suitable for some people if you meet the qualifications. We've actually got another webinar on LTR if you'd like to watch that, where we go through that in more detail. If you'd like more information, feel free to get in touch. So let's really touch on crypto tax announcements rather than generic tax announcements. So how does Thailand tax crypto? You know, how much have they actually published on this? Well, actually, they've done quite a lot of work on this, Thai Revenue Department. So the first announcement on crypto taxation was in 2018. And then 2022 was the first time there was specific rules for crypto digital assets explaining how they will fit into the specific sections of the revenue code. So before 2022, everything went into one specific section, which was section 8. But since 2022, it's pretty clear and it's evident how each type of crypto asset or type of crypto income is taxed. So here are the list of the section 40 revenue code, different parts. So there's 8 different parts on there. And for the main part of this webinar, we'll focus on capital gains. So investment capital gains, so selling crypto assets and then remitting in the gains. Also for domestic, we'll go through that. So that's where crypto capital gains fits in the same section as investment capital gains. So section 40 of the revenue code, part 4. So what does this mean? It means selling, paying, transferring, or exchanging crypto digital assets that exchange exceeds the cost of purchase. That's what it means in terms of what an investment capital gain on crypto is. It's also applied for overseas crypto when remitted to Thailand. Other areas for crypto, I think it'd be good just to touch on. If you do receive salary in crypto, that's actually even put in the revenue code. If you get freelance pay in crypto or from mining, that's also in the revenue code, a different section. Or if you get rewards or you're running a private business in crypto and you get in digital assets, then that's also noted in the revenue code. So it's pretty extensive in terms of the information and how everything is taxed. So now we know what types, where crypto fits in the revenue code and what is assessable income. So it's on the capital gains that are remitted to Thailand, or within Thailand, the capital gains within that year for that crypto asset. It'd be good just to go through what isn't taxable under this income tax rule. So that'd be good to sort of go through. So any asset which isn't, if this is for Thai tax residents, so any asset that isn't remitted into Thailand that's left overseas. Thailand is at the moment a remittance tax basis. This may change in the near future, but at the moment it's only on remittance, so transfers into Thailand. Remittance of cash in the bank as of the 31st of December 2023. This was the announcement that was put in November last year. So let me show you this document here on the right. So that actually notes down that cash in the bank from previous years is not taxable. Remittance of original capital. So if you have crypto, so just crypto assets, and they haven't made a gain, or they've lost money, you can send that money into Thailand and there is no tax implication. Also on a Thai exchange, if it hasn't made money, you sell the asset, there is no tax because there's only tax on the gains. Inheritance, if you receive an inheritance, not specifically to crypto, but if you do receive an inheritance, that's not assessable income in Thailand if it's overseas. Gifts, potentially this is taxable under gift tax rules. This is quite complex area of planning, and also it shouldn't really be used for tax planning, but we can go through that in more detail. Loans are not taxable as income. And if you're a non-Thai tax resident and you transfer assets into Thailand, that's not assessable income either. So how are capital gains actually taxed? So there's two different ways. So if it's a domestic Thai held crypto on a Thai exchange, so what does that mean? If it is regulated by the SEC, the Securities Exchange Commission in Thailand, it's on an exchange for there, you are taxed on the capital gains when the assets are sold. Now you can offset the losses against the profits in that same year, but it has to be reported on the your end of year tax return for the Thai exchange crypto assets. Now, if you're holding crypto overseas, then that's different. So this is based on the remittance tax basis. So only if the assets are transferred into Thailand. If they are not transferred into Thailand, then and not remitted, then that's not classed as assessable income. If you're not in Thailand 180 days or more and you transfer assets, that's also not assessable income. So if you meet the criteria, 180 days or more, and you transfer remitting capital gains from crypto sale into Thailand, then this is assessable income and taxable in Thailand. So the revenue is actually explained how you can actually account for this. There's two specific methods that you can do, which is first in, first out method or moving average method. So it's important, why I want to mention it, it's important because if you are remitting assets into Thailand or selling on a Thai exchange, you can choose the accounting method you use for how you file at the end of the year. You have to be consistent and use the same method, but there's two methods, and sometimes both methods can be favorable in terms of the taxation. So this is the sort of thing that we can help with. So if you are selling assets, we can actually help you calculate which method. We'd run both calculations and see which one's better for you in terms of the taxation and how we file it. So that's what we can help with. We don't expect people to have to know and deal with this, but that's sort of thing that we can help with, is helping people potentially lower their capital gains and taxation. You can obviously do it yourself, but make sure you use the same method for the whole year. And also you've got to make sure that you keep a very good record in case you're audited for up to 5 years in the future, and you're required to keep the records in accordance with accounting standards. So that this discusses the same sort of thing. So basically, what I wanted to mention on this one is if you've got cold storage, so digital assets on a cold storage device, you sell these, you put them back on exchange, you sell these. How we calculate the gains is the capital when buying originally and the selling price. And if you sell them from overseas and remitting the assets into Thailand, it is the all-time gains that we look at. So for each, how do we tax it? So each crypto asset we separate out. It's not the exchange, but the individual asset. So you cannot, it's not, if you're holding a wallet with different digital assets, we look at each digital asset themselves, not the overall gains on the overall exchange. So you can't sell assets and then just remit in the original capital. You've got to either use that first in, first out method or moving average cost method, if that makes sense. We'll go through that in some of the case studies. So any overseas crypto assets, like I mentioned before, that isn't transferred to Thailand is not taxable for now while it's not a global taxation basis. If you bring in cash from previous sales from previous years, that's cash in the bank, that was in there as of the end of last year. That's not assessable income. Original capital, so if you haven't made a gain, you can transfer that in. And obviously, again about the non-tax residence, quite useful to understand. So if you do have a Thai tax filing obligation, so you do have made a capital gain, you have remitted capital gains into Thailand, and you do have to file, then you need to first obtain a tax ID number at your local revenue office. We can help with that Expat Tax Thailand. We have a service for that specifically, or you can go to the local revenue office to get that. And for individuals with crypto gains, that you would need to file a PND90 tax return. So you can file that from the 1st of January next year all the way until the 8th of April if you do that online. You can file yourself, or you can use a paid service like Expat Tax Thailand to actually calculate the gains and actually take the hassle away of filing. So we have a fully online process, so you can do everything remotely. And that works quite well. Everything's online. It's streamlined so that you can do that through the client portal or through the application that you can have on Android and on iOS. So who actually has to file? So anyone that remits or transfers assets into Thailand or makes a capital gain on a Thai exchange itself. So what are the amounts that you have to have in order to have to file? So the greater, if you've got over 120,000 Thai baht of capital gain that is remitted into Thailand as a joint married couple or as an individual single person, if you have capital gains that you've remitted of over 60,000 Thai baht, then you need to file a tax return. This is regardless if you paid tax in any other jurisdiction on this, you still have to file a tax return. Yeah, so that's, the limits are quite low. Income tax brackets after your allowances. So the first 150,000 is tax exempt. And then like most tax systems, it's progressive. So it goes all the way up to 35%. So let's go through some of the case studies, because this will really help with a lot of the questions that we get. So there's 4 examples that we'll go through, and it's really just to try and explain the concepts. If you've got any specific questions, feel free to get in touch, because this is exactly what we advise on, and we can help work out the gains for yourself. So let's go through the first example, which is for someone who's made a gain and they've remitted the assets, but they're a non-Thai tax resident. So if they're, so the same person all the way through, same demographic, 55-year-old who's married. First example here, they're living in Thailand part of the year. So they're not in Thailand for 180 days in the calendar year. They sell 2 million baht of Bitcoin overseas, and they've got a 50% capital gain, and they remit the money into Thailand. Well, because they are a non-Thai tax resident when they disinvest the assets and they remit the money into Thailand, there's no tax liability in Thailand. They don't need to file, and they don't need a tax ID number as long as the exchange is overseas. If the exchange was in Thailand, then if they disinvest and sell assets on a Thai exchange, then that's Thai income, and that would need to be filed. But for overseas assets, that's different. Second case study, so someone who's a Thai tax resident, and they live in Thailand all year round, and they don't remit the money into Thailand. So they sell 2 million Thai baht, Bitcoin overseas, no matter what type of crypto, and they've made a 50% gain. If they don't remit the money into Thailand, we don't file that on the tax return. There's no tax liability. There's no need to file. They don't need a tax ID number. If they ever do remit this money into Thailand, or transfer the money or spend the money in Thailand anytime in the future, though, then it's taxable in the year that it's remitted. So that's really important with this. If they're a Thai tax resident, when they sell the assets, regardless of the year when they do bring that in, it's taxable in that year that they bring it in. It's got to be declared in that year. Next case study, so domestic gain. So 55-year-old, same person, all year round living in Thailand. They sell 2 million Thai baht on a Thai exchange. So 50% capital gains. They'd have to file a PND90 at the end of the year for the capital gains, and they'd be liable for the tax tax on this. So the allowances for someone who's married, 55-year-old, is 120,000. So that's a personal and their marriage spouse with no income. Capital gains, we've assumed 50%. So that's been calculated already in this example. They bought one time, sold one time, very simple case. How do we work out the tax? How do we work out the capital gain to start with? So here's how we actually work it out. So if you've made a 50% gain on your assets, how we actually work it out is we only look at the gain part of the money that you've remitted in. So if you bring in 2 million Thai baht, how much of that 2 million was actually a gain? So we only work it out on that 50% of the profit. So the calculation is, yeah, we just divide the sale price by 1 plus the gain percentage. That gives the original value. And then all we do is deduct the amount you brought in from the original value, and that will be the capital gain. So for this example, if you bring in 2 million Thai baht of assets, of capital from elsewhere, and you've got a 50% capital gain on there, we know the capital gain that we put down as assessable income is 666,666. That's how we calculate the capital gain. So when we go into the tax table, what we do first of all is take off the allowances and deductions from the assessable income, and then we would start to use the tax table. So for this example, someone who brings in 2 million Thai baht with 50% gain on there, you can actually see that the tax on there is pretty low in terms of, so what people were panicking and worrying about. The tax on there would be 34,500 because of the allowances and deductions, and you're only taxed on the capital gain part, remember. So let's get in a bit more complicated situation, which is a bit more of a real life situation. It's just for concept, remember, and it's meant really just to understand how it's taxed. In reality, we deal with clients who remit the cash and sell their overseas assets, and we help them put together the calculations. That's why we've got a job. This is all we do. But I thought it'd be good just to go for an example so that you can just see in principle how this works. So someone who's bought Bitcoin, they bought it at various different prices since 2010. They've held it on an overseas exchange. They've bought 4 different occasions. They live in Thailand and they want to remit in, this example, 1 million Thai baht. How do we calculate the capital gains for this amount? How do we start the process? So first of all, what do we need? We need all the information for each purchase price and also all the sales for the whole time you've been holding that digital asset. This example, we've bought at different prices. So on here, you can see on the left-hand side that they've bought at 18,000 all the way to 58,000 per Bitcoin over the years. As it's overseas, they're only taxed if it's remitted to Thailand. So on this example, we've shown all the purchases, and then they remitted into Thailand 1,056,000 in April this year, just for example. And the other money on there wasn't remitted, so we don't count that on here. All we look at is the money that's remitted. So all we do is we add up all the purchases and we get the average purchase price. This is if we're going to use the moving average cost method. So we can use first in, first out. But just for this example, I'll show you. So we get the average purchase price, and then we deduct off from there. So we times that by what has actually been sold so that we can actually get the original capital price. So bringing in 1 million baht here, 1,056,000, we can see on here that the average purchase price is 37,000 Thai baht. That's how we calculate $37,000. Then we calculate if everything was sold at 66,000. How do we calculate this? We look at the profit and loss on here. So of 1 million baht that's remitted, 592,000, this example, is original capital, and the gain is 464,000. That's how we did calculate it on the moving average cost method. This is the figure that we'd use to put onto the tax return. And again, this just shows you how that would impact on the overall tax return. So we take off, again, the allowances and deductions. We put in the capital gain amount, and then that go through the tax table. So for this example, bringing $1 million Thai baht of assets that have been bought at these different prices and sold, the tax would be 11,900 Thai baht on a million baht. So if you would find it useful to go through a calculation, we actually offer a free tax calculation service. So you can book in a time to have a conversation online to actually go through the figures for your own situation and get a good feel for how much the tax could potentially be for yourself. If you'd like a better understanding, my colleague Jason is an expert on helping people understand their own situation. Feel free to click the link in the email that will be sent out with this video. That will actually have a link so you can book in a 15-minute call to go through the tax calculation. Many people have found that useful. So we also offer tax consultations. So if you would like a more detailed conversation about specifics about your own situation and look at some planning opportunities, we do have tax consultations either in person or online. So feel free to book that in at 10,000 baht per session. And it might be good just to go through now, how will the Thai revenue actually know? So what is common reporting standards? How does Thailand actually know? How would they have transparency on this? And how does this actually look? So we'll go through automatic exchange of information. We'll go through what actually happens with the information and what CRS actually is. So CRS, it started in 2016. It was set up by OECD countries for a way to stop people avoiding tax liabilities. And it's now there's over 120 countries that have signed up to this. Thailand signed up in 2020. And last year was the first year that they were able to receive all the data from all of the other CRS countries direct to the Revenue Department in an XLS file. So all the common countries, all the EU, UK, Canada, Australia, Singapore, Hong Kong, etc. So what is reported with common reporting standards? So all bank accounts and debit cards, credit cards, if you've got investment accounts, if you've got brokerage accounts, pensions, investment-based insurance-based investment products, the information is relayed to the local revenue department, and then over the year, they will send the information to the Thai Revenue Department for Thai tax residents. So the information that's reported is the name, address, account value, transactions in and out. The Thai Revenue Department actually plugs directly into the other revenue departments, and they automatically exchange the information directly. So what's the implication of not declaring any tax that's owed in Thailand on a Thai tax return? Same as every other tax authority and revenue department, the penalties are quite harsh. So up to 200% of the tax that's owed, up plus 1.5% for each month that the tax is owed, plus up to 1 year in jail and a fine up to 200,000 Thai baht. So pretty standard in terms of how revenue departments punitively tax if penalize if you don't file. So let's get on to the services that we can offer. So we can offer free tax consultation video calls to go through your actual situation or go through the tax calculation. We can help with the one-on-one consultations to actually give a more detail and more help with your own situation. We have tax filing services specific for crypto tax in Thailand. We can help people obtain a tax ID number. Just remember, we are here to help. We've produced quite a lot of content and information. We've got a comprehensive guide on how to file taxes, what the liabilities are. If you'd like to take advantage of the free call, you can, or the consultation. And if you'd like to sign up for our tax alerts, feel free to sign up on the website. And this will mean any future changes. This talks about turning into a worldwide taxation basis. if anything does change, we'll be the first ones to let you know with our tax alerts and emails that we send out. So with the tax filing, like I mentioned earlier, we have a service specifically for crypto where we can help calculate the capital gains and do all the work for you to make sure that you're compliant and to keep the tax return as low as possible within the rules. Everything can be done online. We've got a remote client portal. Everything's available online. We don't need to meet up in person. You can do this all remote. So let's get on to the questions. We have had quite a few questions that have come in. So it'd be good to go through the questions on here. So first question, I put a chunk of that came in by email today. I put a chunk of money into a crypto account and take periodic fiat withdrawals into my Thai bank account. Are the withdrawals classified as income and taxed accordingly, or can I freely withdraw funds tax-free until such time I've recouped my initial investment, after which time I'm assuming that further withdrawals can be taxed as capital gain? So this is one of the common misconceptions that we have. And the misconception is you can decide, if you're bringing in capital or income. Well, that's not the case. You have to choose the method of taxation, and then that's how we actually decide on how we tax it. So either the first in, first out, or moving average cost. Yeah, so let's get on to some of the questions. Okay, so yeah, the recording I'll send out afterwards. Someone asked a question about the recording. Yeah, I'll send that across. One question, what about crypto gains realized before January 2024 and remitted this year? If they were in cash in the bank as of the end of last year, then you can remit those assets. It's not accessible income under the rules in November if it wasn't disinvested in the current tax year. One question about, okay, to avoid tax liability, what entity could hold the crypto? Non-profit foundation, LLC trust with jurisdictions are set up for this entity. Okay, so this is talking about how can you set up an entity to hold these assets. So the problem what we've got, if you do hold assets in trusts in Thailand, so if you do hold and trade through a trust, when you do bring assets out of a trust and you pay that into your own personal account, then that's classed as income as well. So you've got to be careful if people are trying to find a way to avoid this, that they're not tying themselves up into something that has a bigger implication than what they're actually, than the gains themselves. Let's have a look at a few more. Okay, 1.5% tax penalty per month. Is that compounded or on the original sum? Yeah, they compound that up every month that it's owed. I'm just trying to read through the questions here. Let's turn off the view and we'll go through these. Okay, what kind of proof receipt is required to calculate the moving average cost for different token purchases over time? Screenshots, trade history. Yeah, so it's really important. This is a question about how to get the documentation in order to prove transaction history. So if you've bought coins and you've sold that and then bought something else, then you've got to look at the whole track record through the whole time period. So it can get quite messy if that's what's happened if you have been trading, but you need to keep a clear record of the whole history. Yes, if you've got the trade history, then that's perfect. In my opinion, it's better to do it whenever you do any sort of trades, because we never know with exchanges that if they get bought out or they close or they change the terms, we might not be able to go back and get the full history. It's important to get that if sooner rather than later. That'd be really good to keep. One question about, if I sell crypto on a local exchange, keep the proceeds on the exchange to reinvest later, is that subject to capital gains, or when I transfer the exchange to my bank account? Yeah, if you sell the assets, it's within that tax year that you need to pay the tax on that specific crypto asset. It's not when you change it to your own bank account. The exchange already deducts tax on each transaction. Is that deductible from any capital gains? So they used to would take withholding tax. Well, it was actually set in the rules that they were going to start taking a 15% withholding tax, but then they stopped doing that. So that's shouldn't be anything deducted on there. Can losses on a year be carried forward to the next year? So that's a good question. On the Thai exchanges, no. It depends how you're holding the assets, right, and what method you're using. So if you're using first in, first out, then you could use that method for. That's why it's important that when you're looking at the accounting methods to use, you use the one that's most favorable. If you've got losses in a certain year, then it might be more favorable to use one of the methods. It depends on your own situation, really. What documentation is accepted as proof in the case of audit? So it's important that you show the full transaction history from the original capital that was invested into whatever you've sold and the sale. So it's important that you keep the whole trail from the time, especially if it's overseas, because with Thailand, you're taxed on remittance. So what does that mean? It means you're only taxed when you remit the assets to Thailand. So it's the whole time capital gains that's accumulated. If you do have the LTR visa, for example, then there are tax exemptions for this. So for some people, that might be suitable if you do have large gains and you do have other assets to qualify. The crypto assets generally are not able to qualify for the LTR. You could look at other assets outside. Let's look at a few more questions. What about if I cash out from an overseas exchange account by peer-to-peer to a Thai bank account? Yeah, it doesn't really matter how the assets are cashed out and remitted to a Thai bank account. This is assessable income. Doesn't matter how, whether that is cashed out peer-to-peer or OTC. It doesn't matter. That's important to look at that. When you do sell the asset, we go through the same method on capital gains. How are stable coins taxed? It's exactly the same. So selling the token assets overseas, bringing in the stable USD into Thailand, cashing out in Thai baht, doesn't really make a difference. You're still looking at the full history of when if I sell overseas, buy a stable coin, bring that stable coin in, you've still made a gain on there. If you're a Thai tax resident, when you sold tokens overseas and bought the stable coins, that's the gain that you need to look at. From your experience, how serious are Thai authorities with expats and their tax situation? I've been living here a few years. Me and my friends have an expression they don't seem to care about us at all. With new common reporting standards and having the direct access for all of the information, the Thai revenue have actually announced that they're taking this serious and they're going to start implementing, enforcing this. Actually produced a lot of documentation and information this year on the new rule changes. And the main purpose is so people understand the rules so that they can start complying and filing accordingly. So I think they are taking it serious. And they will start to become a real thing here in terms of the compliance, making sure that people comply with the rules. You can see with crypto, time history from 2018, when they actually put a lot of work into actually writing it into the revenue code how this is taxed. Now they have the tools to be able to check and actually do a lot of due diligence. So yeah, they are taking it serious. Okay, another question. Are the capital gains calculated separately or together with all personal income, including salary, in the personal income tax return? So very good question. So the capital gains from your crypto or investment assets, or selling a property overseas, or bringing in a rental property income, whatever, that still goes on your tax return at the end of the year. And yeah, it's all added up on the same tax return. So that, if you get in a salary in Thailand, then there might be some tax planning to do in terms of not remitting in capital gains while you're in a higher tax bracket potentially. But yes, it's all added and it's cumulative on top in terms of the tax bands and brackets with the tax that's owed. That's a good question. Okay, good question. If you cash out into other assets, say sell crypto, buy cars, or buy property, sell the property or cars, then bring the cash in, how would the Thai government say it's from crypto that the cash is derived? So, under audit, you would have to prove, all you're doing is, with what was explained on this question, it was about, what about if you layer and buy different assets? This is it's fraud. It's financial fraud by layering into different types of assets and then remitting in cash eventually. If you're under audit, this is an example. If people were to buy cars, buy property, sell those assets, bring the cash in, this is the type of thing. If you're under audit and you were found liable for this, then that's when the 200% penalty would be applied, and the 1.5% tax. Plus, it would affect the visa status, I assume, as well. So these rules, all revenue departments are pretty strict with this type of thing. So if you are going to circumvent the rules, there are serious punitive implications if you do have if you do things like this. Does traveling in and out, stay under the 180 days rule, lift the tax liability? So within a tax year, so 180 from the 1st of January to the 31st of December in any tax year, if you were in Thailand 180 days or more, you're a tax resident. It doesn't have to be consecutive days. You could stay for 10 days, leave, come back, go and come as you please. It's just 180 days in 1 year. If you're 180 days or more, and then you crystallize assets, so you take withdrawals from your assets as a capital gain. If that money is remitted to Thailand, then yes, it's potentially assessable income. Got a few more questions. I think that's pretty much all of the questions. If there's any more that haven't been answered, I'll make sure that you get answered afterwards. And if you've got any specifics that you really need some help with, feel free to get in touch. I can help. We can help. Our team can help either calculate the taxation, calculate the gains, or actually give advice for the one-on-one consultations, the tax calculations, or the tax filing if you do need help with that. Okay, thanks for watching. If you do have any questions, feel free to reach out. Bye-bye.